the best analyst or economist or strategist is the internals of the equity market. It tells you what's going on. In the internals of the equity market, whether you're talking about breadth or leadership, okay, those types of things are telling you that the economy is actually not that healthy internally. It's like a building, right? You have a building, you start chipping away at the bottom of the building, eventually the building is going to have a problem. It's going to become unstable. And I think that's where we are. You just don't know how many more chips you can take at the base.
Welcome to the On the Tape podcast. Guy Adami, Danny Moses, Dan Nathan. Dan, what happens every 3 months? What do they call that? The end of a
Quarter.
Yeah. And we're fortunate enough, Danny Moses, each quarter, who joins us in studio?
Michael Wilson from Morgan Stanley.
Come to the front. Can
Yes.
you do that, please?
Michael Wilson. Let's welcome Michael Wilson to the front stage. Michael Wilson, welcome.
That is amazing. Mike Wilson, how are you?
It's good to be on the main stage.
Well, we are fortunate that you join us each quarter, and I mean that sincerely. And I don't have it in front of me, but Dan, this has got to be what, sixth time that Mike's been with us?
More.
We'll look it up and we'll put it in the show notes. But here we are. We're heading into a holiday-shortened week next week, 4th of July. So it's also quarter end. S&P 500 will go from the top down. We'll talk about your note. We're basically 5,500 or so. I think you sort of saw this coming in slow motion a few months ago, but here we are. So let's just talk about that, and then we'll sort of work our way backwards.
Yeah, I mean, S&P terms, look, first of all, I would just say, the equity market is trading kind of exactly the way it should be given what it's been served up. And when I say, and I think that's where, I think a lot of people agree the market's okay where it is, but I think there's different views as to why we're here. My view is we're here because of this kind of weird policy mix post-pandemic. We have incredible fiscal support, keeping the economy moving at a high aggregate level. That's keeping the Fed probably tighter than they should be. And when I say that, people say, well, why is the Fed too tight? Well, the yield curve has been inverted for 2 years. That's your evidence. And we also see it in the broader economy, right? It's this sort of K economy, haves and have-nots, whatever you want to call it. The policy and on interest rate sense is too tight. Regional banks still haven't really recovered. It's right. Their lifeblood is the yield curve. So I think there's a lot of evidence that suggests that front-end rates are too high. And of course, the offset to all of this is the incredible liquidity that is continually being pumped into the system to kind of keep it all working. And the two or three things that are still left on that, liquidity provisions, the reverse repo still has about $450 billion they could use. The TGA is somewhat bloated at current levels. They could drain that down, which means less issuance. And of course, the Fed is now tapering QT, which equates to, call it $500 billion of purchasing power across the curve on an annualized basis. So in that environment, what's going to change, right? There's fiscal keeping things going. And so what happens is that people are forced to own equities and they're buying the highest quality equities in the world. That happens to be the S&P 500. That is the gold standard. And I think that's the story in a nutshell. That's probably, it doesn't mean it has to end tomorrow, by the way. It can persist. Now, what I think is, the risks to that, beautiful story coming to an end are threefold, or really twofold. One is that you get a reacceleration in inflation and growth in a way where the Fed has to hike rates again, or the bond market starts to push back on this sort of policy mix and the term premium widens out. That would disrupt the apple cart in a big way, like last fall where multiples would come down and you probably see the most expensive stocks get hit the hardest. The other way that it comes to an end is you have a recession. I still think that a recession is more likely than normal. Doesn't mean it's a 50% chance, but it's not 10% chance. And I think that if I look at the data, and we've written about this a lot in the last 2 or 3 weeks, and the data so far this year is that the economic surprises have come on the downside for the most part. So I do think the market is now a bit more worried about growth than it is about inflation, which, by the way, forces people even more down the camp of I want high quality growth stocks or high quality in general until bad economic data becomes bad news.
So you had this chart in your note this week, and I want to dumb this down for people that are listening, because dumb it down to me also. So I'm not just saying this. So equity risk premium is at a 20-year low, and the earnings risk in the S&P is at 20-year highs. So Right. So explain why that is so important. And that ratio seems to be one of those infallible type ratios that we are at the levels now where it just can't get much.
Well, either you need earnings growth to reaccelerate in a big way. Okay, you need revisions to start really picking up, which is the expectation, by the way, in the forecast. So we need to see now the rubber hits the road on that, or valuations need to come down. So it's one or the other. So I do think that that's why we had a $5,400-$5,500 sort of target as our base case. That would be kind of it. We're there. A bull case would be you could trade through 6,000 because it's a late 90s scenario or Nifty 50 period where multiples just keep going up and equity risk premium goes negative. I can't rule that out.
But but the premium itself has grown more than earnings because we're at the level now. I'm looking at this chart here on the ratio. So at some point, to your point, it's got to give. I understand what it means, but which do you think happens, I guess, is what I'm saying.
I think growth is going to disappoint. I mean, that's the camp we've been in, and that'll take care of the multiples. Now, the multiples should basically figure this out ahead of time, right? We should start to see multiples just start coming down, even if the soft landing scenario plays out, right, and growth is okay. Typically, as the growth comes through, multiples will come down. Don't forget, we're in the top decile of PE multiples right now, S&P terms. And if you cyclically adjust it, it's even worse. So we're not saying the multiples have to go to 15 times. We're just saying it goes from 21 to sort of 18, 19 times, which is more normal. It's still rich, but it's acceptable. And in that scenario, that's why you don't get much upside at the S&P level.
Right. And on the multiple and the earnings growth, it's all in that top 10 stocks in the S&P 500 for the most part. And here's something, my friend Doug Cass forwarded this to me. And, this goes back to, let's call it 1999. Mike, you were covering tech back then. And this is pretty fascinating. So NVIDIA recently traded 100% above its 200-day moving average. Since 1990, the widest spread versus a 200-day moving average that the largest U.S. company has ever had was 80% by Cisco in March of 2000, which provided to be an all-time high. And, we can go on and on here. So if you think about the concentration, right, in market cap and then earnings expectation and valuation in those top 10 names, and you just said that at some point the market will get in front of that and it's going to hit the most expensive stocks, where do you think, how does that happen?
Our, clients who I speak to more frequently, the institutional crowd, has been sort of fading the AI trade. I mean, because what I would say, so there's the enablers, which always goes first. Some people call them the picks and shovels, fine. Then there's the adopters of that technology. There really aren't any adopters yet. That's to come. But some stocks got bid up on that. And what's happened, as you know, in the last 3 to 4 months is that any company that mentioned the phrase AI got a boost on their multiple. And in the last 6 weeks, what's happened is the market now is starting to say, nah, actually, there's a bunch of AI pretenders. And so it is starting to clear. It is starting to happen. So the process has begun, right? The rationalization of kind of who are real winners of this and who are the pretender hanger-ons, if you will. It's getting sorted out, and that's the way it typically happens. And then there's usually an event. So when I say an event, I mean it could be an economic event, it could be a disappointment in this trend, and there will be disappointment in this trend at some point because it can't persist at this rate, and we're already seeing it in some of the names. So it'll be a combination of those two things. And then, of course, if there's a market event of some kind, like a term premium blowout or a recession, then these stocks become the most risky, because this is what people own, right? We're not there right now, obviously, right? But that's what you have to understand, though. If you're plowing into just the passive index, you have to understand that you own the riskiest thing out there, because that is where the liquidity will hit the hardest when that event occurs. Could be a year from now, right? Could be 6 days from now. We just don't know.
You mentioned term premium event. Have you been surprised? I will tell you, I have been surprised by... I thought by this time, and again, it's the end of June, we would see some really terrible bond auctions that would send rates, meaningfully higher. We've seen a couple bad ones, but I will be honest, on the margins, they've actually been decent. Has that surprised you?
Well, the liquidity under the surface, you can measure this in certain ways. The liquidity in the Treasury market has deteriorated, but not in a way where the term premium has really widened like it did last fall. And I agree with you, Guy. I mean, I thought the bond market would start to push back again, particularly after some of the elections that are happening around the world. We have, the French elections this weekend. I mean, this is kind of it's happening now. This is not a U.S. problem. This is a global problem where governments have just spent too much money. And in certain parts of the world, it started in the UK a few years ago. We're starting to see other European markets now push back on this idea that, that the funding is going to become a problem at some point. Japan, in many ways, I mean, they can't raise rates because they have a funding issue. And that's why the yen now is sort of, weakening further and further every day. So it's happening. And look, the United States is still the cleanest shirt in a dirty closet. Okay, so it's moving in that direction. That's all I can say.
So it's interesting you say that, because is it because of what's happening in other countries that maybe you're seeing this flight to perceived quality in the form of U.S. bonds? So it's somewhat counterintuitive. As negative as the things you're talking about should be, they actually wind up being on the margins a positive thing, because that's where the money flows are coming from.
It's always like that, right? I mean, it always the highest quality assets always get really rich at the end when there's no place to go. Okay, so that's what's been going on for the better part of 18 months. I mean, look, Europe up until recently and Japan, were outperforming the U.S. for a period of time because people were looking for new pockets to go to. That luster seems to have come off because people have woken up and said, well, wait a minute, hold on a second. We're talking about Europe now. We're talking about Japan. These situations they can't be as good as what's going on in the U.S. As bad as we're Americans, like whenever you go to a country, right, the people who are the most bearish are usually the people who live in that country, right? So as bad as we think it might be here, it's actually pretty darn good, okay? And we still have incredible assets. The government could sell off assets. They could raise taxes. They will raise taxes at some point. So when you really think about the sustainability of our situation, there's a lot more runway still left. And I think that's the benefit of the doubt that bond investors are giving to the United States, probably correctly.
I know Danny has strong thoughts about this. I do as well. So you mentioned Japan. I've thought for a while that Japan is going to be the epicenter of all this. And you mentioned dollar yen. As we're sitting here, dollar yen is through 160 to the upside. That's the level that the Bank of Japan intervened at back in April. They were able to get the dollar down to 152, and it came right back. You've just mentioned sort of peripherally, sorry, guys, I can't say that word. I'll say it again. You just mentioned sort of tangentially how, they're sort of in a difficult situation here. Elaborate on that, because I do think at some point that's going to make its way over here to the United States.
I'm impressed you did it without the thesaurus. I can't
Thank
say
you.
That's
a hard one.
Anyway, so yeah, look, it's all part of the same game. And we talked about this for a while too, that Japanese rates were the first ones to bottom in 2016. So Japan actually led us into deflation 30 years ago. And as strange as it sounds, that I think the Japanese bond market is kind of the Pied Piper in many ways. And now that situation is becoming a bit loose, becoming a little tenuous. So it's the beginning of the end of this financialization super debt cycle that's been building for 30 years. Now, that doesn't mean it's over tomorrow, but I think the process has begun. The behavior of the last 30 years has to now kind of become more disciplined, and Japan is just a symptom of that, I think, what's going on.
So if a lot of this market has been predicated on faith in central banks that we just talked about, you saw a crack, as you mentioned, in the fall of 2022 in the Bank of England, right, for a moment in time. Bank of Japan started this entire central bank experiment decades ago. When does that, so if that were to unwind, as Guy's talking about, the yen goes through 170, 175, and they really have a crisis over there. On a relative basis, there's a crisis in all assets around the world. When does that mentality potentially creep into other global central banks? BOE was able to stem it, change prime minister, buy some bonds, and kind of stop it. So when does that matter, and what should investors be looking at to even care about that? That's what we've been trying to kind of...
Yeah, I don't think investors can care about it. That's almost like a natural disaster.
Yeah.
So you can't plan for that.
Mr. Leary's couch situation.
And that's why people don't think about that. It's like saying, well, when's the next geopolitical event going to be? I spend zero time thinking about that. And I kind of view this as sort of the same thing. I know it's out there, but until something metamorphosizes in a way where it becomes a contagion, there's really no use in thinking about it.
But there is math associated. There is math that's actually associated with it.
Sure there is.
So,
but you still need something to start the chain of events. And the other thing I'd point out is, we've had a series of these events in the last 3 or 4 years, but they've been able to, whack-a-mole it down to get it stable. So that's why another reason why I think people seem so comfortable continuing, because there is this faith that if something pops up, they will do whatever it takes. And they will. But at some point, there'll probably be a policy mistake. It's just impossible to predict what that policy mistake is going to be.
Let's talk rates for a second. You just said they're a bit restrictive, right, for the most part. And if we're looking at the CME Fed Funds tracker, they're saying it's a 58, 59% probability that we have a 25 basis point cut by September or in September in the meeting. That's SEP 18. And then it's about 50% for November. I think that's assuming that, the September materializes. What are your thoughts there? Because obviously the Fed funds versus the inflation rate, you know what I mean? And I think we're probably all in agreement. I don't think any of us think that inflation, the CPI is going to drop like so meaningfully, like on its way to 2.5% anytime soon. So like how restrictive is it, and what are you expecting for interest rate cuts in this year? And then some of the things we're reading is that folks are expecting by the end of next year down 300 basis points.
We're looking for 2 to 3 cuts, officially 3, but maybe it's 2.5. I don't know, something. And then another same thing like next year, definitely more. So seven cuts by next summer, if you will, all packed in. So that's a decent amount of cutting, and that assumes, however, that there's no hard landing, right? So look, history is the following. Since 1973, we've had 11 rate cut cycles. Half of them have been good for stocks and half of them have been bad for stocks, okay? So in other words, there's a 50-50 chance they're too late, and there's a 50-50 chance that they're going to be able to orchestrate the soft landing. Flip of a coin. That's not how markets are priced. So equity markets are not priced for a 50-50 outcome. Equity markets are priced for an 80-20 outcome, in my view. That's how I think about it. What's interesting is we're getting a lot less conversations around the Fed with equity investors in the last 2 or 3 months because they've kind of come to the conclusion they're not raising rates. So as long as they cut, I'm good. And to me, there's a little fallacy in that because of the statistics I just gave you. And I would argue that be careful what you wish for. I think what's going to be interesting to watch is when the Fed starts cutting rates, let's see how the equity market reacts to that. I'm not convinced that the equity market is going to like it because my guess is they're probably cutting rates. If they cut rates before September, obviously there's been a growth problem. I would argue even if they cut rates in September, that means growth is probably disappointed further. And I'm not so sure the equity market's going to agree that 25 is enough. So we'll see. We'll see how it goes.
Yeah, but again, what if they just get cooler data? You know what I mean? It gives them that opportunity to do it and put up a mission accomplished sign, you know what I mean, on a soft landing. I think into that, and Guy and I were talking about this earlier, pretty soon we're just going to hear Jackson Hole, Jackson Hole, Jackson Hole, right? Late August. And I think stocks could rally into that if the anticipation is that there's cooler data, which gives Fed the cover to do that.
The bad is good, essentially. And that's what's priced in. I mean, that's the whole point. It's that's the trail we've been on. That's what we identified late, and we turned less bearish and said, yeah, we can rally up to 54, 5,500. Okay, fine, here we are. But to get much beyond this, I think you need the Fed cutting and you need growth to stabilize and even improve a bit now. I don't think a continued deceleration in growth and 25 is going to be well received. I mean, the market now, in our data would suggest is now more concerned about growth. So you better start seeing some positive growth surprises at the margin, whether that's earnings or whether that's economic data or both.
I think what you're describing is it's been over 2 years now since this hike cycle started. And companies, we've been through 9 different quarters of company earnings. So the companies that have been able to sustain growth and deal with the inflation are getting rewarded, to your point. And so it hasn't mattered. You also had the advent of the greatest secular trade since .com of AI, which is completely rate agnostic because it's the saving all the world and humanity. But my question to you is this. You mentioned that it's a great time for active stock pickers that recognize those things. But at the same time, I still feel like passive is the one driving the train and forcing the hand of a lot of active managers to not underperform their benchmarks. And so with the passive flows still occurring, right, active are kind of a little bit handcuffed and prisoner to that. Give me your thoughts on how, as an active manager, they're forced to manage this. And we're seeing new data right now is saying that big funds, or at least hedge funds, are starting to underweight tech now again for the first time in a little while. I'd love to hear your thoughts on that.
Well, I would say, look, first of all, it's not just 7 stocks. There are a lot of stocks that nobody ever heard of that are doing fine. Like if you look at the small cap index, it's the same factors that are driving the winners in that segment too. It's basically earnings vision, breadth, growth, and quality. So there are small cap companies that are navigating this well. There's just not many of them. So that's one way that I think active managers have kind of navigated this. And our data would suggest that a lot of our clients are actually capturing a lot of this alpha, which is encouraging for them. And it's encouraging for that this can persist. Like it's not like 2023. Last year, I mean, a lot of active managers really underperformed because it truly was 7 stocks. Okay. Now I think there's actually some things that are doing okay. And as I said earlier, I think that the sort of smarter, more active managers are starting to fade the AI thing. They are starting to underweight tech again because it's just been prolific, and there's a lot of pretenders in that bucket. So they are looking for new names. I think it's going to be harder now because valuations are rich kind of across the board. I think the second half returns are going to be tepid at best. And if you get a surprise on the upside on rates or term premium, or you get a surprise on the downside on growth, it could be significant correction. And I just like to remind people, every year you get a 10% drawdown. Okay, so going into the election season, you should expect vol to pick up and a 10% drawdown. That's not the question. The question is that a buying opportunity? Is that the beginning of something more, sinister or dangerous? We're going to have to make that decision now. We don't know right now, but I'm pretty confident we're going to get a pretty good fat pitch down 10 sometime in the third quarter. But I remember October, it's not that long ago. It felt like the car was careening into the wall, that we were heading into recession then. And then the policy was able once again to step in and correct course.
That was some Janet Yellen commentary that really got things back on the rails. So, you address the small caps. I'm going to lump them in with the next two. So small and regional banks have not traded particularly well now for quite some time, nor has the transports as measured through the IYT, which we have said a number of times is not the best constructed ETF, but for lack of a better one, that's the one that people look at. So I'm sort of leading the witness here, but they seemingly suggest the growth scares and some of the things that you're concerned about are happening right before our eyes.
It is happening, but that's how we sort of made money under the surface. We've been underweight or short those areas of the market that are very susceptible to economic downside surprises, and then staying overweight the areas that doesn't matter so much, where funding is unlimited, or there's a story or an organic growth story. They've been, people have flocked to that stuff. So that pair, people keep trying to come in and say, well, we're going to revert. No, we're not. That's not going to change until there's a true regime shift. When I say regime shift, I mean in the macro narrative, right? And that could happen in the third or fourth quarter. Some of it could be election related, that it, affects the term premium in the bond market, perhaps. Could be growth related. Could be another shock of some kind that I'm not in the business of trying to predict. But the market is way more fragile under the surface, which is really what you're asking. So why is that? For all the reasons we just talked about. And so in many ways, the market is not irrational. It's expensive.
I think investors have been given the excuse to ignore the slowing labor market. There's no question it only has one direction to go. And there's more than half the people, I'm sure, in the economy that feel it, because AI, as I mentioned before, has nothing to do. So professional investors and people who invest in the market are paid or get rewarded for buying the right stocks and not having to worry about that stuff. At what point does Dan's point about when the Fed may start to cut rates, right? So inflation comes down just a little bit more, but jobs get worse and unemployment gets worse, gives the Fed enough ammo to do that, which is, I think, what you're describing is the reason that stocks may end up selling off, because at some point, this momentum, or lack of momentum, I should say, on the weakness is going to overtake the exuberance and what we just talked about at the opening of the show. When does that happen?
Well, it could happen this year or it could happen next year. I think it's hard to imagine that we get all the way through 2025 without a proper growth scare. And the reason why we could maybe persist the rest of this year is because there's still a lot of bullets in the gun, if you will, to on both the fiscal side and from a liquidity standpoint to help fund it. So I think, look, the way I think about the Fed is it matters whether the Fed is cutting because they have to or because they can. And right now, the market is assuming the Fed's going to be cutting because it can. It has room to give some cuts, not because growth is so bad. But that's a fine line. I think we're closer to that line, obviously, than we were last year when things were rip roaring, economically speaking. This year, once again, all the growth signals are weaker. The first quarter GDP growth was 1.4%, and the quality of the growth was poor. It was big inventory build. And consumption forecasts now are coming down again. So you're well below potential GDP already. In real terms, and that stuff could even get restated. So I think we're closer to being on the edge of that. But until it's like proven to the market, I mean, the market's not going to go there.
Well, to your point, the S&P sold off nearly 11% from the July highs last year to the October lows. Stocks like Microsoft sold off 15, 16%. So a lot of those high flyers, they came out with some of the product announcements and the like. Since then, Microsoft's up 47%. Right. Okay. And I want to be really clear about this. It trades about 38 times, fiscal 24, nearly 14 times sales, and that's 34 times next year, fiscal 25, and 12 times sales. And I just wanted to, there was an article in the Information, this is Thursday, and I think this is really important. In a surprise, OpenAI is selling more of its AI models than Microsoft is. Now, we know that Microsoft invested $13 billion in this company, and a lot of us were like, when is the monetization going to really happen here? When's it going to be turned on? I think there's a really bad headline for Microsoft. And I just want to make one other point is like, when I look at expected earnings growth in this quarter that's going to be reported, okay, in let's call it a month or so, 9%, big decel from like 20% for the last few quarters plus, okay? So is there an announcement lurking out there where if Microsoft were just to come in line and let's say guide in line, is that it for a while? Do we have this sort of July to October period like we had last year? Because if Microsoft's not monetizing this and it's trading at these sort of multiples, there's probably another 10 stocks behind it that are a disproportionate amount, like we said, of earnings growth and the multiple.
Well, I mean, look, the comparisons are difficult. We wrote about this back in March, April. One of the reasons we thought there'd be a correction, coming out of March, which there was, is because the comparisons for the big 8 or 7, whatever you want to call them, were getting tough again. And that's exactly what you're saying. So that there's a giant deceleration in the growth rate, which is what stocks care about. And I think this is why a lot of clients, institutional clients, are lightening up on tech. They're saying, wait a minute, there's a growth decel here. So where's the money going to go? Well, I think industrial still has decent revision breadth. That's an area that's kind of big cap. I think you could see money go back into some of the traditional defensives like staples. Utilities got a bid here recently on that same idea. Some of that was AI hype, but I think it was more a function of the fact that the revisions were decent. So I think all that is true. And I mean, my goodness, 47% rally in one of the largest companies in the world. I mean, it will take a break. I mean, at a minimum, it doesn't mean that like, oh, I got to sell all my Microsoft stock. It just means like you've enjoyed a lot. So you should expect flat returns for a while.
Yeah.
Or down.
Hey, I want to make one big point because to Guy, how he started this, you've literally been coming on every quarter for at least 2 years or so. And one of the things that, we get kind of frustrated is some of the media narratives around folks like you who make big proclamations. You write a weekly report, okay? It's 5 pages long. You often spend a lot of time talking about sector rotations, and there's money to be made in doing that. And so I just wanted to make that point. I think it's really important because we track your stuff very closely, right? And so the S&P target is such a goofy thing because a lot of media outlets, that's all they focus on, a little bit.
Well, the other thing I hate is people say, are you bullish or bearish? Well, that doesn't even mean anything to me. Like I'm an investor. I'm trying to find, there's some things I'm bullish on, there's some things I'm bearish on. And it just so happens that we get pigeonholed into, predicting a target on an index at a time, specific time frame. And that's just, A, it doesn't help anybody, okay? And B, it's impossible. So we're not making excuses. I don't know anybody who's done a good job over a 10-year period. I thought we had a pretty good run. Great, we got credit for that. But the idea that that's sustainable is dumb. That's not what clients pay us for. It's not what people listen to this show for. You guys have great guests on. You're rarely talking about your S&P target at the end of the year. So why make strategists talk about that? Let's talk about your process. Let's talk about like where the opportunities are, both long and short.
Well, in terms of process, there is something that historically has meaning for the economy, then subsequently the market, that over the last few months people have seemingly forgotten about because I think it's so long in the tooth now. And I'm talking about the yield curve, which when we made it to March of this year, it became the longest inversion, I think, since 1978 to 1980 or something around there. And I mentioned it, nobody really talks about it anymore. And I think people figure, well, it's different this time. But, we got down to about 13 basis points. We were trying to re-steep, and we're back probably about 45 or so now. What are your thoughts on that? I mean, to me, it's sort of out there like this sort of Damocles that at a certain point is going to have meaning, but market participants seemingly have forgotten about it.
Yeah, I call it the yield curve apologists. And it happens every cycle, by the way. Every cycle going back in my career, it's like, I'm not sure the yield curve matters this time. It always matters. And it is different this time, and it's different every time. Sometimes it's a really fast indicator, it's coincidence. Sometimes it takes 2 years. And why is it? So the question is, why is it different this time? It's different because of all the fiscal stimulus and the savings that got built up during the pandemic, and the cash that was kind of put into the system provided sort of a buffer against it having the sort of really negative labor shock that it typically has ultimately, where companies have to lay people off. We also had an immigration situation that nobody predicted, but now everybody's taking credit for. They're saying, oh, yeah, well, immigration is a huge positive labor shock. Has kind of kept the labor market going because it's cheaper labor and people can hire those folks for low-end service jobs. Okay, great, but is that going to persist forever? I mean, we have an election coming up where immigration is probably the number one issue. And one way or another, the flows on the border are going to go down between now and year end, whether Biden gets reelected or Trump gets reelected for a second term. So I think that those are things that people have just forgotten about because the stock market's going up. And in my experience, the best analyst or economist or strategist is the internals of the equity market. It tells you what's going on. In the internals of the equity market, whether you're talking about breadth or leadership, okay, those types of things are telling you that the economy is actually not that healthy internally. And that goes back to our whole thesis around crowding out, right? This policy is crowding out small businesses, most consumers, and it's very corrosive around the edges. And so it's like a building, right? You have a building, you start chipping away at the bottom of the building, eventually the building is going to have a problem. It's going to become unstable. And I think that's where we are. You just don't know how many more chips you can take at the base.
I think the advent of private credit has also mitigated some of the concerns about the yield curve, because the truth is, there are economic implications to the yield curve being inverted about banks' funding costs versus what they're willing to lend out. Premium time for sure. I want to go back to a comment you made, why S&P targets don't matter. And to me, they matter for one reason, not the number, the sentiment. And the sentiment, if you have to recognize from a behavioral finance perspective, and I feel like this market has been based all on sentiment, the expectations of rate cuts, even if it's really not going to mean anything. But when everyone's on one side, whether it's negative or positive on a stock, and you recognized this a couple of years ago and went bullish for a period of time with it. So I think it's important from an indication perspective, not because it matters. So, get your thoughts there. And my follow-on to that is, what is the driver to shift the sentiment? So forget about AI for a second, forget in general. What is going to be the one thing that you think would be the one thing to change sentiment?
So one thing I'd say, so first of all, we have a lot better measures of gauging sentiment than people's S&P target. Like there's sentiment indicators from institutional investors, retail investors. We can see it in the flow data. Those are, I think to me, those are better gauges of sentiment. And I would say sentiment now is like an 8, or maybe 9 on a scale of 1 to 10. I've seen it higher, but it's pretty high. And then in terms of, what shifts sentiment, it's price. I mean, that's what shifts sentiment. I mean, price momentum, both up and down. As soon as if price starts going down, there's plenty of reasons, fundamental reasons to be bearish on a lot of different parts of the equity market, but nobody wants to sell if price is going up. Similarly, think about October 2022. It was so bearish, nobody could see any way out of it. Okay, but it was so bearish, and then all of a sudden price started going up, and then people started making up stories as to why it could be positive. So it's price. That's why we look at technicals so much. We look at exhaustion type technicals, which is different than trend following. We look at like when things are being exhausted. And on that measure, there's a lot of signs, give away the whole store on our technicals. We could be here for 4 hours. But and some of it's voodoo, but it works. And basically we are at kind of an exhaustive stage for a lot of, not only the equity market broadly, but a lot of important stocks.
You mentioned our election here. I don't want to get into that necessarily, but there have been elections around the world that have had implications for their markets. There was a Mexican election where their markets sort of fell out of bed for a period of time. India had an election where you saw a knee-jerk reaction to the downside. This is anecdotal right now, but it's starting to become the norm in terms of what we're seeing. How important is this going to be going forward?
Well, all the things we've been talking about here, this crowding out, this very archaic economy, this is a global phenomena, and it's an outgrowth of the same policy that's been going on around the world, which is basically asset inflation. That really is what AI stands for. It's asset inflation. Right? That's what we have going on globally, and what that does is it creates a situation where people recognize it. They're like, well, wait a minute, like everybody's talking about this great economy and I see people on Instagram, they're posting their best lives and it looks wonderful, but like not for me. I mean, like my life is tougher and I don't like inflation and my rent's going up every month and that's why consumer confidence is weaker. And so people are going to the polls and they're voting the people out. And it doesn't matter if you're right or left. It just means that if you're not thinking about the average person in your policy choices, you're going to get voted out of office. And that's kind of what Modi was about. His power got weaker because people are not happy with how things are there at the average state. Obviously, it's what's going on in Europe now. Mexico, perhaps the same thing happened in the UK. It's the Labor Party now is going gangbusters. Argentina is kind of a situation like that. It's the extreme case. Okay. By the way, the prime minister in Japan is not very popular right now because this policy is not particularly great. They don't like inflation either. And so now this election is going to be about the same thing. And to me, this is the whole thing's coming to a head, right? The fiscal sustainability. And by the way, it's also kind of dangerous because if you're a politician and you know that people want more, that means there's going to be less fiscal constraint. Okay, so like it actually makes the fiscal sustainability thing come to a head in many ways. And I think that's what the markets could come to terms with. It started to happen in the bond market in Europe, which is why some of the equity markets there are weaker. Hasn't happened in our market yet, but I think it's a potential risk as we go through this election cycle that the bond market starts to worry that neither side is going to be disciplined on this spending issue because that's what keeps them in office.
Well, if that becomes the central issue, then you can't even think about that because you start to think about the implications of that. The equity market would be down a ton, meaning people's willingness to fund our debt and so forth like that. I don't know. I'm on the 10-year yield. It's a battle all the time. From a flight to quality versus what we talk about here in the auctions, the potential failed auctions or the need to fund the ongoing government. Because if you have to worry about the inability to fund the government, then none of the four of us are not sitting here necessarily. So how do you reconcile the 10-year yield, which has been and continues to be a driver, a buy signal or sell signal for the markets? Because I've argued an actually rising 10-year yield, not spiking, but rising, is not an unhealthy thing given the fact that we can sustain a 5 to 6%.
100%. I mean, just think about it this way. So rates went up last year and the market hated it. Why? Because it was term premium. Rates went up this year and the market was fine with it because it was better growth and better inflation. People don't understand it, but higher inflation is better for average stock because it means you get more nominal revenue growth and they can turn into earnings growth. So, and stocks do better when there's higher inflation relative to bonds. So I don't know what the magic number is, but I'm with you on this. I think that 10-year yields at 4.5, I have no problem with that. That's not an issue. Front end rates at 5.25, I think, is potentially the issue. And that's what's slowing things down. So I think that I don't think that we're going to have a problem funding the debt. Okay, I'm not one of these guys who's like, oh my God, we're going to lose the reserve currency. No, but the cost of debt is going up in a way where choices are going to have to be made about spending. And then we're going to have to see, okay, how does the economy perform without all of this government spending going on? I don't think it performs very well right now. I'm optimistic in the long term we'll figure it out. Quite frankly, I'd like to see it sooner it happens, a better chance we have of figuring it out and becoming more organically driven economy. But I mean, it's not happening by choice. I mean, that's clear. They're not going to make the choice proactively. It's going to be forced upon them probably through a bad bond auction or term premium or something like happened in the UK temporarily, some sort of a event that'll force them to be more austere, kind of like in 2012 to 15. I mean, the government was very austere after the GFC because we did blow out the budget and to basically take care of the GFC, and the bond market wouldn't absorb it. So something like that's going to happen. It doesn't have to be the end of the world. Okay, there'll be good opportunities on both the long and the short side. But these are the issues of the time. These are the issues we got to be talking about.
Let's talk about the dollar relative to, let's say, large multinational U.S. earnings, because again, this is important. And I thought it was interesting over the last couple months as we saw the 10-year yield go from 4.75 down to 4.25. The dollar kind of strengthened and started going up before we saw yields kind of bottom. Now we're at 4.3 or something like that. What is dollar strength, and I get it, relative to what's going on to some of the other pairs, you know what I mean? But what does dollar strength mean for U.S. multinationals if we were to continue to go? The Dixie just went from 104 to 106.
Yeah, I mean, usually when it gets to be like a 10% year-over-year headwind, it starts to be a real problem. We're not there right now. We're flattish year-over-year. So I don't think this is an issue for earnings today. I don't think it'll be an issue for earnings until we get to probably 110, 115, something along those lines. So that's not top of my list of of concerns. And quite frankly, what the stronger dollar is telling me right now is that people still want to own our assets, which is positive, right? I mean, like people still want to own high quality growth stocks in the U.S. and they still want to own treasuries. So to me, these are positive signs that this game that we're playing will persist.
What do you make of the commodity market, not individual stocks, just in general, in terms of, you had that huge acceleration of the upside. A lot of these commodities, for example, copper gave back half of the move to the upside recently. So there's been a pullback, whether it's on the back of slowing growth. I'm not convinced I know the answer, but commodity markets to me are still in play. And very quietly, you've had this move in crude oil to the upside. Thoughts on the importance there?
Well, the trend is down in most commodities for a while. Even cocoa, which went crazy, it was a spec asset, and that's come in. Crypto, I view as kind of a commodity. So to me, and even gold. I mean, gold has been weaker the last month or so. All those markets are a little bit smarter. Remember, those are all professional markets. There's no real retail trading going on in those. Well, I guess crypto there is, but the true commodity markets. And what I would say is that I think liquidity may be getting weaker at the margin a little bit. That's kind of what it tells me, in addition to the fact that my baseline view is that growth is softer too. So it's a combination of weaker growth, a little less liquidity, a little less robust liquidity. I don't think it's a flashing, red light right now, but it's probably more of a flashing orange.
You're looking at globally, and I know we sat here when you came in here today. You can see it on your face. We're all kind of like, we just accept what's happening right now. But deep down, you got this thing. What is the one thing you're kind of looking for? Not to explode, not that you'll be full of joy, but what is the thing that you kind of want to see happen that validates all this knowledge and all the stuff that you've been putting together? Because you've been forced to play the game a little bit in terms of you've always been yourself.
Sure, of course, yeah.
But what are you looking at?
Well, yeah, I'm not playing a game. I mean, I'm taking what the market's giving us, and I think a lot of smart clients we speak to are doing the same thing. And so what I'm looking for, I think the framework that we developed over 20 years is still very much intact. And so what I'm been spending the last 6 or 7, 8 months is trying to figure out, okay, why did the models not kind of prove out to be what we thought they would do, and how much time do we buy? Like, that's where I am in my head right now. We didn't eliminate the risks that were all there last year or still in the background. We just sort of papered them over in a way that people have forgotten about them. So I'm just waiting for the event or shock or moment when all of that comes back. It's like it becomes obvious.
It'll matter again.
This has been going on the whole time. It's just we forgot about it. And it's no different than other cycles, Danny. You know this. I mean, we don't have to list them all out, but I mean, it's the same thing in 19. It's the same thing in 2006, 7. It's the same thing in 89, 90. It's the same thing in 1999, 2000. So it's very similar to that. Is there a chance that this is 94, 95? Sure. Of course, there's a chance that somehow we get another 3 or 4 years out of this cycle. I don't see it. But I mean, that's what I was talking to my team the other day. I'm kind of like this interested spectator now. Mm-hmm. I just kind of want to see how the story ends. I don't know. I mean, I'm not. I mean, I've butchered enough stuff over my career, right? And now
join the party.
Now I'm kind of curious.
Well,
to say, okay, how is it going to be different? And we're going to learn from that. And that's why we do this every day. I still love it. I still have the passion to kind of try and figure this riddle out.
It does amaze me, the whole immediate gratification or the immediate right wrong on an hour or a day or a week when there's thematic thoughts going on about how to play long-term investment cycles. And I think whether that's a good thing or a bad thing, I'm not speaking for you, but the three of us try to just lay the things out that you should be looking at and be aware of, because when it does turn and all of a sudden this map starts popping up and things start filling in on it, and you're like, what do you mean? I didn't think about that. Why does the yen matter? Why does the 10-year, why do these things matter? And when they start to matter and you try to plug those back in, you're going to be the guy that has the key. Or when, in Raiders Lost Ark, when he holds up the thing and the light shines through to show where the thing, I think he's the only one that has the thing, that's going to see where it comes in. So
what I can say is right now, I'm pretty confident about this idea that there's not a lot of value in the marketplace right now. It's been picked over, okay? That doesn't mean you can't make money being long or bullish on certain things or trading, and that's what we have to do every day. But the risk reward right now, okay, I mean, obviously it's not anything like it was last fall, okay, or fall of 2023 or March of 2020. And that's what's clear to me. So now we just have to be judicious about how we put capital to work and how we recommend certain things. so we're not putting people in too much of harm's way, and that we're acting responsibly, so that then we can take advantage of a really fat pitch when it comes our way.
We're digging in the wrong place.
That's right.
Right. No, but so let me ask you
That's
this.
a good one.
So you mentioned before fat pitch, let's call it down 10, 12% or something like that. You mentioned, what's working right now based on money flows and rotations, the industrials, utilities. Those won't be the same groups that if we were down 10 or so percent that you probably want to buy, right? Is that a safe assumption?
Depends. I mean, it depends on what's going on. I mean, down 10, 12 could be the beginning of something worse, or it could be a low. And yeah, down 10, 12, you're probably going back to the well of the high quality, favorites.
Yeah.
is my
And
guess.
how are you? We haven't even mentioned energy. This is an area that Guy and Danny have. Does, let's say, slower growth, and does that factor into anything here? Where are you in energy in general?
Well, I mean, energy's traded terribly for the last month, mainly because growth has been weaker and the commodity prices have been softer. So I don't think that's a mystery. I think the question is, look, if it's truly a mid-cycle slowdown, energy should be a place to put money to work. I'm not as confident anymore in the energy trade because growth is fading in the way the material stocks trade. So unfortunately, I think you're probably, for energy to work, you're going to kind of need to get, you're going to need the full cycle. Like that's going to be something you're going to come back to it when, when we have the hard landing, whether that's this year or next year, we'll have to see.
Before we get out of here, and understand the answer to a question like this is, a combination of all. However, is there one metric that you're watching very closely to sort of give you the indication, okay, this is the beginning, whether it's unemployment, the credit markets, again, it's all of those things I know, but one of them sort of stick out to you?
Fundamentally, the one that matters the most by far is the labor markets, and it's basically non-farm payrolls. Now, I think there's enough evidence to suggest that the labor market's a lot weaker than what people think already, but the market needs the proof. It needs to see it in non-farm payrolls. It needs to see unemployment like at 4.4, so you trigger some of these rules, and then that would be something that I think would get people's attention in a big way, fundamentally speaking. The reality is, like all of us, what I'm really watching is the tape.
Right.
I'm watching price action and those exhaustion measures. And so, like in April, I'll be honest, in April, I thought, okay, that this is the beginning of something more significant. And then we had one more kind of lift. Now, if you notice what happened in that rally from the end of April till today, you've lost more participants. Mm-hmm. The breath has gotten even weaker. So one more time, here we go. So the next one, we'll be looking for the same thing. But I would tell you right now that, so technicals and price, along with the labor market, those are probably the main things that we're focused on right now. That could change. And I would say if the term premium were to start to widen out, that would get my attention probably ahead of all three.
All right, Mike Wilson. I mean, it's at least 8, Guy. Okay, I'm just
I'd have to go back and look.
now.
If we had our own Ken show, Ken show would know. By the way, Ken show is that AI bot, I think, that CNBC created.
They were so early on that.
There is another number the two numbers that matter just as much.
Well, the question was for Mike.
I know, but I want to, before we get out of here, because I have Guy sitting to my right. 21-9. Does that mean anything to you, those numbers?
That's probably how the Mets outscored the Yankees in this 2-game set.
Okay, I had to get that out because you shit on the Mets all the time.
Did Vinny call in?
No, but I was feeling like I had to represent Vinny, who sits in this seat a lot at this time, just to call that out.
No, that's fair enough.
Enjoy your slump right now.
So here's one thing I'd say. So you started out by saying Mike's joined us pretty much at the end of each quarter over the last couple of years or so. What would you say, Mike, would be one of the biggest changes that could happen? Would it be the expectation for rate cuts to kind of speed up? If we're having this conversation 3 months from now, Jackson Hole is Aug 22 to 24 or something like that. We know there's not a Fed meeting. Would it be a change in posture of the Fed 3 months from now that is probably one of the biggest things that could cause, let's call it, the equity markets to take a shift from this 5,500 level?
I don't think the Fed's going to change posture that much if things are fundamentally are the same.
Yeah.
So I think the bond market probably has it right, 1 to 2 cuts in status quo. But I do think there's a chance that they're cutting more if there's a growth disappointment. So that's definitely one thing. Once again, I think people have just forgotten about the election because nobody wants to think about it. But elections have consequences. We've seen all over the world. Whether it's a good or bad outcome from a policy standpoint is irrelevant. It's a higher vol situation, and that I think people on this call should be listening or should be waiting for that at a minimum. To if you've missed this year, I wouldn't be piling in here. Let's wait for that vol spike and take it down, whatever, 5, 10, 12%.
Mike Wilson, we are fortunate that you join us each quarter. I hope that trend continues And thanks for being here with us yet again.
My pleasure, guys.